Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Our discussion about equity, chapter 15. So previously we have described about different forms of business organization, and we focus on corporation because the corporation has the most complex structure of equity. And we have discussed about special characteristics of the corporation, like the influence of corporate law within specific country, and use of the share system. Yeah, so share has different classification and it has different structure. Yeah? So it results also in the development of variety of ownership interests. Yeah? Because like ordinary shareholders, they would have a different ownership interest as compared to the preference shareholders. Yeah? Okay, we won't discuss anymore about the corporate law because we have discussed that previously. So basically, when you see equity of a corporate, you would have a different classification like share capital, share premium, and then it has retained earnings, accumulated other comprehensive income, treasury shares, the shares that we buy back, and the minority interest. Yeah? So basically the primary sources of equity are two, which are the contributed capital, which comes from the capital or the shares being purchased by the investors. And another source is the retained earning. The retained earning is the profit of the company that is not being distributed as dividends to the shareholders. Yeah, means the profit or the earnings that is being retained or maintained within the company. Yeah. And this contributed capital, it may come from ordinary shares, it may come from preference shares. Yeah. For each classification of shares, you would have share capital account as well as share premium. We have discussed that. Share capital is recorded at the par value. Par value is the stated value in the article of association of the company. Yeah? The company is granted the right to, is authorized with certain number of shares at what par value for the shares that they want to sell or issue. Yeah. And when they sell it, it may be above that par value. Let's say the par value is $1. When they sell, it may be $5. So the difference, which is $4, it will become the share premium. Yeah, for each classification, whether ordinary or preference shares. Yeah, and all the equity will be deducted with treasury shares account, because treasury is the shares that we buy back, the company buys back or reacquire from the shareholder. Yeah. Okay. Okay. This little bit about the equation here. Why equity is called as residual interest in the company? Because the equity holders would be the last one to receive any balance from the asset minus liability in case of the liquidation. Yeah. So in case of liquidation, all the liabilities will be settled up first. After that, only it will be the balance will be distributed to the equity holders. Yeah, that's why it is called as residual interest in the assets of the company. Yeah. Okay, there are certain issues with regard to the issuance of shares. First, about the par value shares, yeah, and second, certain shares that don't have par value, so we call that as a no par shares. And then there's another issue whereby the shares issued in combination with other securities. Also, if the shares issued in non-cash transactions, how do we value? What is the value of that transaction? Yeah, how do we measure it? And then what about the cost of issuing the shares? Yeah, when a company issues the shares, there are several costs involved. Yeah, like legal fees, accounting fees, underwriting fees. Yeah, the tax. Yeah? So anything involved with the cost of issuing shares, how do we treat it in accounting? Yeah? Okay, first let's talk about par value shares. Yeah? Par value shares, the par value is the stated minimum value of the share being authorized to the company is stated in the article of association or the corporation charter of that company. Yeah? And normally the company will choose a very low par value, yeah, because it would avoid the company from a contingent liability in case if the company is not able to sell the shares above the par value. Yeah? So if the company sets a very high par value, let's say $10, they set $10, and then when they issue it, the share can only be sold for $5. Yeah. So the company is liable for the difference because the selling price of the share is below the par value. Yeah. So it creates the liability for the company to fill up the difference. Just now, the par value is 10, for example. The selling price is $5. So there is a difference of $5 which the company has to pay in excess, yeah? Because share capital is always must be recorded at the par value or stated value. Yeah? So for par value, the company would maintain accounts specifically for share capital of preference shares and share capital of ordinary shares. Yeah? The excess above the par value will go to share premium. Yeah? Share premium for preference shares, share premium for ordinary shares. Yeah? Okay, very rare. We would find that the company has a no par shares, yeah? Whereby the shares doesn't have any par value. Yeah? It is allowed in certain regulation to have a non-par shares. And the reason for the companies to opt for non-par shares because they want to avoid contingent liability as I discussed just now. Yeah. So they don't have that stated value. Yeah. Whenever they issue the shares, that's the price that they would record. Yeah. But a major disadvantage for a non-par share that some countries they impose quite high tax on these issues. Yeah. The total issue price for non-par shares may be considered legal capital, which could reduce the flexibility in paying the dividends. Yeah? Okay, let's say this one, the example for non-par shares. Let's say this company is authorized with 10,000 ordinary shares without par value. So let's say they issue 500 shares for cash at 10 per share. It would immediately record cash, debit, and credit share capital ordinary. Yeah? So it doesn't have any share premium account because it cannot identify what is the difference between the par value and the selling value because it doesn't have any par value. So all the amount goes to the share capital account only. Yeah. So if it issues another number of shares, it would again record debit, cash, and credit share capital. Yeah. Whereby for the par value shares, normally it would record debit, cash, credit share capital, and credit share premium because it's normally issued above the par value. But anyway, despite that the company choose to have a non-par shares, but certain countries require for those non-par shares to have a stated value. Yeah? It's almost similar like par value, but they say a stated value. Yeah. So if a company issued 1,000 of shares with a 5 euro stated value at 15, this is 15 is the selling price per share. So it would record debit cash 15,000 and then share capital ordinary at the stated value 5 euro times 1,000 and credit share premium. Yeah? So stated value is almost similar to par value. Okay, another issue, what if the shares issued with other securities, means it's a lump sum transaction. Yeah? So let's say we ordinary shares is issued together with preference shares but with one price, yeah, or ordinary shares is being issued together with bond, yeah. So how do we allocate the proceeds between the different types of securities? Yeah? Because we do not know, let's say they sell, they issue preference shares and ordinary shares for 1 million US dollars, and it cannot be identified how much belongs to the ordinary shares, how much belongs to the preference shares. Yeah? So there are two methods of allocating the proceeds. First is proportional method and second incremental method. Yeah? Actually, this is similar to fixed asset that was we learned about buying the fixed asset together in lump sum. Yeah? Let's say we buy land together with building. How do we allocate the cost of land and the building? So the same thing like shares issued in lump sum with other securities. So we use proportional and incremental. The same method like we did for the fixed asset. Okay, for example, the company issued 300 shares of $10 par value ordinary shares and 100 shares of 50 par value preference shares for a lump sum of 13,500. Yeah? We do not know this 13,500, how much is the selling price for ordinary shares and how much the selling price for a preference shares is combined in one price. Yeah. But we have information. Ordinary shares have a market value of 20 per share and preference shares have a market value of 90 per share. Yeah. So if we use the proportional method, we will find the proportion of each class of shares based on their market value. Yeah. Okay, let's say now ordinary shares, it has number of the 300 and then we times with the fair value of 20 per shares, then we get 6,000. And the same thing for preference shares, how many number of shares being sold, which is 100, and we times the market value, it gets 9,000. So we identify the proportion for each class of share, which is 40% for ordinary and 60% for preference. So what do? The issue price is 13,500 and we times with the proportion based on the fair value for ordinary shares, which is 40%. Then we can identify how much of 13,500 belongs to the ordinary share. Yeah, so it gives us 5,400. Yeah? And then preference shares the same way. We take the proportion of 60% and we times with that lump sum price of 13,500. Then we get 8,100. So we can allocate how much belongs to the ordinary share and how much belongs to the preference shares. Okay, so the double entry would be, would debit cash 13,500 and then share capital preference 100 times 50. Remember, the share capital account is always based on the par value. If it doesn't have par value, then we take the stated value. Yeah? For the case of non-par value, the whole thing goes to the share capital account. Yeah? And then share capital, share premium preference is the difference. Yeah? Remember, for preference, we allocate 8,100, yeah, for preference shares. So that's why the balance of 3,100 goes to share premium preference. Yeah? And the same method for ordinary shares. We credit share capital ordinary, which is 300 times the par value, and then credit share premium ordinary 2,400, yeah, based on the allocation that we did just now using the proportional method. Yeah? Okay, what second method of allocating the selling price for shares issued in lump sum or with other securities is by using incremental method. Yeah? The same example. So incremental method, let's say the fair value of ordinary shares is identified, which is 20 per share. And let's say we do not know the fair value of preference shares. Yeah. So we just calculate for ordinary shares first. 300 times the fair value, we get 6,000. Yeah. So this 6,000 straight away we allocate to the ordinary, to the preference, to the ordinary shareholder, sorry, because ordinary shares 300 times 20, so you get 6,000. Yeah. So that 6,000 we minus from 13,500. Then the balance will go for preference shares. Yeah. This is what we call as incremental method, because we just identify one of the values and the balance will go to another class of shares. Yeah. So debit cash, credit share capital preference, and the difference go to share premium preference. Because just now for preference we get 7,500, remember? So 5,000 is based on par value. The balance 2,500 goes to share premium. Yeah? And 6,000 we allocate for ordinary shares. Yeah? Share capital ordinary shares always based on par value 300 times 10, and then share premium ordinary, the balance of that 6,000 minus 3,000. Yeah? So we get 2,000. Yeah? What about another issue with regard to the shares issuance? What about the shares that are being issued in non-cash transaction? Like previously, you have explored about fixed asset being acquired in non-cash transaction. We buy fixed asset, but we don't pay cash. Yeah, we give another asset in exchange. Yeah, so the same thing like shares issued in non-cash transaction. We issue the shares, but we don't get the cash. Yeah, so the basic rule for shares issued in non-cash transaction is we have to value the cost of that shares issuance must be on the fair value of the goods or service received. Yeah. Or if that value cannot be measured reliably, then we have to use the fair value of the shares issued. Yeah. So let's say, for example, the company issued 10,000 shares of 10 euro per value ordinary shares for a patent. Yeah? So they issue the shares, they sell the shares, but they don't get the cash, they get the patent. Yeah? Let's say in this example that this company cannot determine the fair value of the patent, yeah? But it knows the fair value of the shares is 140,000. So then we can record, instead of debiting the cash, we will debit the patent of 140,000. And we credit share capital ordinary based on the par value 10,000 times 10 euro, and the excess will go to share premium, yeah, ordinary 40,000. Yeah. In another way, if the company can determine the fair value of the pattern instead of the shares issued, then we use that value to record the transaction. So debit pattern 150,000, credit share capital, and credit share premium. Yeah. Okay, let's say there is another possibility that the company cannot identify the fair value of the shares issued and the fair value of the assets being exchanged. Let's say in this example is better. So the company has to hire a consultant to evaluate or to assess the value of the pattern. Yeah. Let's say it used the discounted expected cash flows method, and it identifies the value of 125,000. So the journal entry would be to debit the pattern 125,000 and credit the share capital and credit share premium. Yeah. Okay, another issue with regard to the issuance of shares is about the cost of issuing the stock. Yeah, I mentioned to you there are several costs involved in issuing the shares. Yeah, the underwriting cost. Yeah, we need to hire the underwriter. Yeah, someone that is being appointed to handle the issuance of shares. Yeah, there is a broker, yeah, in the stock exchange, yeah? And then there will be also accounting and legal fees involved in issuing the shares, printing costs, the tax, yeah. So all these costs must reduce the proceeds received from the sales of shares, yeah. So normally the company will debit the share premium account for this expenses because it will reduce the whole amount being received from the sale of the shares. So we debit the share premium for these expenses. Yeah? Let's say for legal fees incurred, let's say 10,000 US dollars, then we debit share premium 10,000 and we credit sorry, we debit the legal fees, and if we pay with cash, then we pay with cash, but then that will reduce our share premium account later on. Yeah. Okay, we discussed a little bit about the preference shares. Yeah, because preference shares is unique shares. It has certain privileges, yeah? Certain special rights with the preference shares, yeah, because they are more prioritized in terms of dividends. Yeah? When in case of liquidation of the company, then they would be more prioritized as compared to the ordinary shares to receive the asset. Yeah? And preference shares are also given the rights to convert their shares into ordinary shares. Yeah? Let's say at one point of time, they want to convert their preference shares into ordinary shares is possible if the terms about such thing is included in the issuance of shares transaction. Yeah? And also it can be callable at the option of the corporation. Yeah? The company may call back or they may buy back that preference share, yeah? At any point of time. Preference shares doesn't have any voting right. Yeah? Okay, several types or features of preference shares. First are cumulative. Cumulative, I discussed with you last week. Cumulative preference shares means when at certain year, the company is not paying dividend, and the dividend that they have to receive within that year will be accumulated for the next year. Yeah. So in the next year, let's say the company will pay dividend for all the shareholders. The preference shares would receive not only the dividend for that year, but for all the previous dividends that it has not been paid by the company. Yeah. Okay, and then participating preference shares. Yeah. If it is a participating preference shares, mean the preference shareholders will be given the right for the additional dividend in case the company makes profit beyond the percentage that is being promised to the preference shareholder. Yeah? So let's say if the preference shares was promised for dividend of 5%, yeah, and then at certain year the company is distributing more than 5% to all the shareholders, including the ordinary shareholders. Let's say ordinary shareholders get 8% for that year. So participating preference shares will get additional beyond the 5% that is being stated in the terms. Yeah? They are supposed to receive only 5%, but because the company is distributing 8% to the ordinary shareholders, they will get additional 3% of dividend. Yeah? So they don't only get whatever being agreed in the beginning. They would get more than that when the company is distributing more dividend. Yeah? Convertible preference shares. Yeah? When they say convertible preference shares, means those preference shares can be converted into ordinary shares. Yeah? If they want to. Yeah, because sometimes maybe they see the performance of the company is being increasingly better over the years, and they can see that the company is distributing higher profit to the ordinary shareholders. So they want to convert their shares to become ordinary shares, yeah, or they want to have voting rights. So they want to convert the preference shares into ordinary shares. Yeah. Another type of preference shares is callable preference shares. Yeah? This type of preference shares means the company may at any point of time call back that preference shares or buy back. Yeah? And quite similar to redeemable preference shares, whereby there is the redemption period for that preference shares. Yeah? So let's say until the next 2 years, the preference shares will be redeemed again by the company, or it will be purchased back by the company. Yeah. So any term can be specified within the preference shares as long as it does not violate any specific countries incorporation law. Yeah? So the company may specify whether the preference shares that are being issued is cumulative or participating or convertible, or it can be both participating and convertible, yeah? Or it can be callable. Any kinds of terms can be specified, yeah? As long as it is within the law. Yeah? And the accounting treatment for preference shares is basically similar to that for ordinary shares. Yeah? Let's say, for example, the company issued 10,000 shares of £10 par value preference shares for 12. 12 is the selling price. Yeah? So we would debit cash. Debit cash 10,000 shares times 12, and then credit share capital preference and share premium preference, yeah, the difference. Yeah? Okay, a little bit about the acquisition of shares. I mentioned to you about the treasury shares, right? Treasury shares are the shares that are being purchased back by the company after they issued. Okay, why the company wants to purchase back their shares? Oh, by the way, I hope you still remember what's the difference between outstanding shares, issued shares, and authorized shares. Yeah, authorized shares are the total number of shares being stated in the article of association of the company. Yeah, what is the maximum number that the company can issue? Yeah, issued shares are the number of shares being actually issued. Yeah, and normally not all authorized shares are being issued by the company at one time. Yeah, they will issue step by step. Yeah, and outstanding shares are the issued shares minus the treasury shares. Yeah, so outstanding shares are the actual number of shares being owned by the shareholders. Yeah, so the company may purchase part of the outstanding shares. Among the reasons are to provide tax efficient distributions of excess cash to shareholders. Yeah, normally the tax involved in the company buying back the shares from the shareholders is normally lower than if it is purchased by other investors. Yeah? Another reason is to increase earning per share and return on equity. Yeah? Earning per share is if you see the income statement, you will see at the bottom, earning per share. So profit, the total profit divided by total number of outstanding ordinary shares. Yeah. So if we reduce number of shares, that EPS or earning per share will be higher, yeah, because the earning will be divided by the lesser number of shares. Yeah. The same with the return on equity. Yeah. Okay, sometimes the company wants to keep some number of shares for the purpose of employee compensation or to meet the potential merger need. Yeah, if they do the merger or business combination with other company, they need to provide certain number of shares for the shareholders of the other company that they are doing the merger. Yeah, so they need to purchase a certain number of shares to provide for that allocation. Yeah? And then sometimes the employees are being given the bonus not in terms of cash, but they are given the shares in the company, yeah, to motivate the employees to be loyal to that company. Yeah? So the company may want to purchase some parts of outstanding shares for the purpose of giving the shares to the employees. Yeah? Okay, another reason, sometimes the company wants to avoid the potential of takeover by certain shareholders. Yeah, so they need to acquire back the number of shares to control such possibility. Yeah, and they may want also to reduce the number of shareholders. That's why they are buying back the shares. Yeah. Okay, another possible reason for the company when they reacquire the shares is to create the market in the shares. Yeah, because when the company buys the shares, it creates the demand. Yeah, the market will identify, oh, there is a transaction for this company's shares. Yeah, so it may stimulate the market to further do the transaction in the shares for this company. Yeah, we create the demand. Yeah? Okay, for the purchase of treasury shares, how do we record that transaction? There are two acceptable methods. First is cost method, which is most commonly used. And second is par or stated value method. Basically, as I've been mentioning in the beginning as well as last week, the treasury shares would reduce the total equity. Yeah. So in this example, we have this structure of equity, share capital, ordinary, and then share premium ordinary. It doesn't have any share capital for preference. And then it has retained earnings of 300,000. Let's say the company is purchasing the treasury shares. Okay, first the company issued 100,000 shares of $1 par value ordinary shares at a price of 10 per shares. And then on January 20, the company acquires 10,000 of its shares at 11 per share. So the company would record based on the cost method. Yeah, cost method means we take the whole amount that are being incurred when the company is purchasing back the shares. Yeah? So if it acquires 10,000 at 11 per shares, so the value of treasury shares debit is 10,000 times 11, which is 110,000. And then we credit cash 110,000. So that is cost method. Yeah. And under cost method, the whole amount of treasury shares will be deducted from the total equity. Yeah? If it is a par value method, we would split the amount of par value and the difference between the par value and the purchasing price. Yeah? And the treasury shares would reduce the share capital account only. It doesn't reduce the whole equity. Yeah, but focus on the cost method, because that is commonly used. Yeah? This is the cost method. You would put the cost of treasury shares at the bottom of equity. Yeah, after all the equity items. Okay, what about after we purchase back those shares and then now we want to sell it? Yeah, so there are two possible scenarios. Let's say if the sale of treasury shares is above the cost or below the cost. Yeah, both of these two situations will increase the total assets and equity. Yeah. Okay, after the company acquired 10,000 shares at 11 per shares, it now sells 1,000 shares at 15 per share. Yeah, so this is above the cost. Remember, the cost was 11. It sells for 15. Yeah, so would debit cash 15,000 and would credit treasury shares 11,000 because we use the cost method. Yeah, so we identify what was the cost previously incurred to purchase back that share. So we credit treasury shares 11,000 and we credit share premium treasury. Yeah, 4,000. It's like the issuance of preference shares or ordinary shares. Yeah, but this time is treasury shares. You don't record share capital here. You credit the treasury shares. Yeah? Let's say if it is below the cost, yeah. If for this example they sell for $8 per share, yeah. Remember the cost was 11, so the selling is below the cost, yeah. So we debit the cash 8,000, and we will debit the share premium treasury 3,000 to fill up that 11. And we credit treasury shares at 11,000, yeah, because the cost is 11,000. Yeah. Okay, let's say if we see the share premium account for treasury, the balance is only 1,000. Yeah. Let's say there is another transaction below the cost. Yeah. For this example, sell additional 1,000 shares at $8 per share. So again, below the cost, we cannot debit the share premium 3,000, right? Because it only has a balance of 1,000. So the difference that we cannot get from the share premium account, we would take it from the retained earnings. Yeah. So debit share premium only 1,000 because that's the only balance that we have in share premium account. And then the extra that is not sufficient from the share premium account, we will take it from the retained earnings. Yeah. And credit treasury shares again at the cost, yeah? 10,000 times 11. Okay, so treasury shares, we purchase back the shares and then we may sell again those treasury shares. Yeah? And in another situation, the company may retire. Yeah? May retires the treasury shares means it may put back those treasury shares into the unissued shares. Yeah? Or we cancel the treasury shares, so it will reduce the total number of issued shares. Yeah? So basically, we delete those treasury shares. It come back to the total number of authorized shares. Yeah? So the number of issued shares will be less now. Yeah. So the retired treasury shares, it will have the status of authorized again and unissued shares. Yeah, we don't want to further do the transaction with that treasury shares. Yeah, we put back into the number of authorized shares. Okay, I stop at that, and I'll continue with a part of this topic later on, inshallah. Please read your chapter and ask me if there is any question. Okay, Assalamualaikum.